Welcome everyone to Vested Interest. This is Shane back again for another stock pick of the day video, and we have done it. We are over 1,000 subscribers. Really appreciate everyone out there who's taking the time to do that. Thank you so much. It is Monday, July 15th. We're going to take a look at a subscriber suggestion here. Justin Weeks 3907 commented on a snap-on video here a couple weeks ago. Subscribed. What are your thoughts on TFPM RTX AWK? Thanks. So I do own AWK. It's in my portfolio, so I do like the company. I'll do an updated video on that sometime in the future. Same thing with RTX. I've done a video in the past on this one, so check out the channel. It has been several months back though, so I'll do an updated one here in the future. But today we are going to take a look at Triple Flag Precious Metals, ticker TFPM, out of the material sector. So Justin, this one is for you. Let's jump in. And again, over 1,000 subscribers now. I think we're at 1,003 whenever I looked before this video. So really appreciate all of you out there who have taken the time to do so. But if you have not done so, or if you are new to the channel, if you could do me a favor, hit that thumbs up button down below. Hit that subscribe button. Make sure you are subscribed to the channel. Join us on this journey to financial freedom. Join the Vested Interest community. Hit that notification bell so you're notified whenever we put out any new content. And we do subscriber suggestions, so another good reason to hit that notification bell. So if you do make a suggestion, click that notification bell so you're notified whenever we put out that video in the future. Now, this is the Vested Interest Stock Screener. This is how I look at a company on a high level to see if I am interested in investing. It's also how I set up the videos here. So we're going to run through this criteria on this company. And we'll see if it meets 5 of 8 or 6. If it was a bank, 6 of 9. It's obviously not a bank, so we won't look at price to book. So we'll look and see if it meets 5 of 8 to make it onto my watch list. And that's what this screener does. It puts the company on my watch list. It doesn't mean I'm buying. It just means that it meets the initial screening, and that means I'm interested in doing more of a deep dive into the financials, looking at their balance sheet, their income statement, their debt to equity ratios. Is their margins growing over time? Are they paying down debt? Lots of good information. I also look at stuff like the PEG ratios, dividend yield, growth over time. There's a lot of good metrics out there that I look at. Assets over liabilities, again, growing revenue, growing margins. A lot of good information in the balance sheet and income statement. And if you are not interested in doing that, doing more of a deep dive into the company, I also do a discounted cash flow analysis to see around the price I'm willing to pay for the company. If you're not willing to do all of that, you should not be investing in individual companies. You shouldn't be blindly watching YouTube videos and investing in things other people are telling you to invest in or other channels are covering to invest in. Make sure you understand how to look at a balance sheet, how to look at an income statement, and understand what you're looking at and what you are investing in. That's part of being an investor. If you don't want to do that, that's fine. There are other ways to invest into the market. You could do ETFs or index funds. VOO is the S&P 500, and that's what Warren Buffett would recommend. I believe VOO is still in his portfolio. SPY is another one, SPY. Those are both ETFs that track the S&P 500, which whenever you hear people talk about the market, that's what they're talking about, the S&P 500. Another one that I personally invest in, which is another ETF, is called VTI, Vanguard Total Stock Market. So it's all the companies in the stock market, not just the top 500 companies like the S&P. And then another one I like is SCHD, which is Schwab's Dividend Growth ETF there as well. So those are a couple ETFs that I invest in: VTI, Total Stock Market, and SCHD, which is the Dividend Growth ETF. So if you don't want to do deep dives like this or even screeners like this into companies, ETFs or index funds are the way to go so that you don't have to do any of those deep dives. Now we're going to get back to the video here. www.tripleflagpm.com is the homepage where I pull this information from. That's www.tripleflagpm.com. That is their homepage. And Triple Flag is a pure play, precious metals focused streaming and royalty company with proven execution capabilities in the most attractive segment of this market. Our focus on cash generating mines and construction ready, fully permitted projects with development times of 2 years or less to cash flow is balanced by prudent investments across earlier stages of the mine life cycle to maintain exposure to a robust collection of development stage assets and grow free cash flow per share over the long term. We pride ourselves on adaptability and flexibility in structuring financing solutions that are customized to meet the needs of our mining partners. Our aim is to be a valued finance partner facilitating development and expansion of mining projects that deliver value for our counterparties. As a result, a high portion of our deal opportunities have been sourced from referrals from our existing counterparties, as well as our network of contacts, leading to bilateral discussion with potential partners rather than auction processes. So what you're seeing here is actually a finance company that specializes in financing to miners and mining companies, is what it seems to me. Now, some of that is, buying into mines or owning a portion of that mine, as well as loaning out money that mining companies will pay back, is what it looks like, at least from looking at their homepage. If you go over here to their investment criteria, we focus our investments on underlying operations with cost structures and sustainability practice that ensure the viability of the mine while also assessing the financial risk of our counterparties and prioritizing contractual protections in order to enhance the security of our investments. Commodities exposure, gold and silver focus, balanced by assuming exposure to base metals and bulk commodities. ESG values, core to triple flag. We believe in the essential good that ethical mining providers provide society and recognize that optimal ESG performance in the mining and metals business derives operational and reputational performance. Stage, producing or construction ready and fully permitted, balanced by prudent investments across early stages of the mine life cycle to maintain exposure to a robust collection of development stage assets and grow free cash flow per share over the long term. And their geographies, the Americans and Australia, is where they're providing that capital for investments. Balanced by willingness to pursue assets globally for appropriate risk-adjusted returns where we can ensure adequate protections and the asset quality justifies it. So again, they're a capital provider providing loans and capital to mining companies. That really seems to be their bread and butter here. Now, the reason we were taking a look at them down 2.19% on the day, closed out the day at $16.10. We are talking about Triple Flag Precious Metals Corp. That's ticker TFPM, out of the material sector, and they are out of the material sector. Even though they are providing capital and providing loans to mining companies, they are still under the material sector. 52-week range as low as $11.75, as high as $18.08. They are closer to their 52-week high than their 52-week low. They are not within 15% of their 52-week low, so they would not get a check there. Market cap of $3.239 billion, so a small cap company here. Their beta is in the negative, actually, 0.23, so that means they're much less volatile than the overall market, off the charts with less volatility, even though they were volatile throughout today. PE ratio, this is really high, $89.44 per share, 89.44, that's pretty high. EPS is sitting at 0.18, so earnings per share is 0.18. Earnings date is coming up, we just passed it May 8th last month. So go check that out if you're interested in how their earnings went. Forward dividend yield, they do pay out 21 cents. They are quarterly payers, divide by 4, or we'll see that here in a little bit. Very low yield on this one, 1.28%. Ex-dividend date was May 31st. Looks like they just paid out on June 14th. So you would be in line for the next dividend if you were to buy them now, though you're going to have to wait a couple months to get it. 1 year target estimate, at least according to Yahoo Finance, where I pulled this information from, $19. So they do see some upside as far as price appreciation on this one. Now we're going to jump over and look at dividend yield theory. Unfortunately for this company, we can't really use that because their 5-year dividend average, they've only got a few years of dividend paying out dividends. I think it was 3 years. We'll see that here in a little bit. So this one does not really apply. So we can't use dividend yield theory. We'll have to go with its current 1.28, though their trailing annual dividend yield of 1.26 is slightly lower than their current. But according to dividend yield theory, we can't use it because we need a 5-year dividend yield average. Now, this I do not like. Both sources that I look at for information say that their payout ratio is over 100%. I like 75% or under. So this is not good. I think that's a little elevated for me. Now, it doesn't necessarily mean it's a bad thing. Sometimes you'll have a company go through a quarter or two where the payout ratio gets wonky. It's just a little elevated right now. It would be something to watch, especially if you own this company, Justin. Now we're going to jump down to free cash flow. We want growing free cash flow over time because typically if a company has growing free cash flow, they have growing dividends. Now we went back to 2020 here. You can see negative 645 million here. 2021, they jumped way up to 68 million in free cash flow. 2022, it looks like a little bit of a drop down to 66, but we'll talk about that here in a minute. 2023 looks like even more of a drop down to negative 36. But again, if you look up here at repurchase of capital shares, they are repurchasing their shares not back in 2020, but they started in 2021 repurchasing some shares here, 1.6 million. 2022 even more, up to 4.1 million, so that will account for some of that drop in free cash flow. And 2023 up to 20.7 million. So I'm not going to do the math, but I'm going to actually call this growing free cash flow because of the significance of the repurchase of their own shares here, right? Now we're going to jump over to stockanalysis.com. This is another source that I like to go to for information. You pick any source that you like. Just make sure you're picking more than one so you make sure the information you're getting is accurate and up to date. They do have 5 analysts that have taken a look at this. They call it a strong buy, though it is right on the edge of a strong buy and a buy. They have a low estimate of $19, which would be higher, 18% increase from where it currently sits. Average estimate of $20.60, which would be a 27.95% increase from where it currently sits. And if it happened to hit their high estimate of $23.53 or 50 cents, that would be a 45.96% increase. All the while, you could collect that 1% dividend. Now we're going to look at return on equity and return on invested capital, see how well this company is investing back into itself. I like 10% or better for these metrics. They're pretty low. Return on equity sitting at 2%, lower than 10% I'm looking for. Return on invested capital 2.33%, lower than the return I'm looking for. Though with them being a company that loans out capital, some of this might be, a little skewed, I'll say, because it depends on when they give out those funds. How long are they're saying within 2 years for return on capital, so they may be projecting out that they're not going to get any return right away, which if that's the reason, then it would make sense that their ROE and their ROIC is low initially with the potential to grow in the future. So some of this, because the company is relatively young, might be skewed a little bit and not really great metrics for a company like this. Now, EPS growth is smoking high. I like 5% or better. They've got them listed at 36.62% forecasted over the next 5 years. That is just smoking high. And if that comes to fruition, wow, that's really good. Now we're going to jump over here and look at their dividend history. Again, only 3 years of dividend growth. They are a quarterly payer. Payout ratio, they're saying 150%. That's very, very elevated. Dividend growth of 5%. So they are growing their dividend over time, even though it's only 3 years worth of growth. They do pay on the March, June, September, December timeframe. Going back to November 2021, they were paying 4 cents and some fractions of a penny. Raised it up in 2022 in August to 5 cents. Raised it up again August 2023 to 5 cents and some fractions of a penny. And I would anticipate in their next August raise, they will continue that dividend growth if they are going to do so. So let's jump back over to the screener. Look how this one shakes out. Understand the business. That's where we started. Check there. Growing free cash flow. I gave them a check. Even though you'd have to do the math and see if that's actually accurate. Growing dividend, it is growing. That should be a check there. So my bad there. That should be a check there. They are growing their dividend. Dividend payout ratio is not under 75%. No check there. Check valuation based on dividend yield theory. Dividend yield theory we can't use because they don't have 5 years of average growth to compare. It is not within 15% of a 52-week low. The return on equity and return on invested capital is not within 10% or better. Their earnings per share growth smoking high. It's over 30%, so I like that. So if you get the one that I missed, the growing dividend, that would be 1, 2, 3, 4. It does not quite make it onto my watch list, though, like I said, with it being such a young company, this one, a lot of these metrics, especially like the 5-year dividend growth or the check valuation based on dividend yield theory, I need 5 years of dividend growth. So, that's just not going to apply. Some of the others, like I said, return on invested capital and return on equity, if they're looking at companies that are looking to be cash flow positive within 2 years, they're willing to accept a lower return on invested capital and return on equity initially, with the idea that they're going to start seeing that within the first couple of years. So long as the companies they're saying can pay their bills, they're not really looking for a lot of return on equity and return on invested capital right away. They're looking for something 2 years out or sooner, obviously, but that's kind of what they're saying on their website anyway. So a lot of these metrics might not be great for this company. on my screener, it gets 4 or 5. It just doesn't make it on my watch list. Hopefully, hopefully, Justin, I don't know if you've invested in this already or not. Let me know in the comment section down below. Well, let me know what you think of this company. Interesting one. It's not a mining company. It's a company that, loans out capital to mining companies. So it is definitely an interesting company. It might be one that I throw on my watch list anyway, just so I can take a peek at it over the next couple of years, a couple of quarters. So if it was to pull back within 15% of its 52-week low, that would put it on my watch list. So again, might be one to just keep an eye on. It is interesting. It's not one that I've seen before. I don't know any other companies that are like that, actually. As always, appreciate you stopping by. If you haven't done so already, don't forget to show me some love. Hit that thumbs up, ring the notification bell. Most importantly, subscribe to the channel. Join us on this journey to financial freedom. Join the vested interest community. I do personally read and respond to the comments. I'm always interested to read your questions, suggestions, opinions. Let me know what you think of this company. Is it one that you've even heard of? It was not one that I had heard of until Justin brought it to my attention, so really appreciate the suggestion. And this is Shane signing off, wishing peace and prosperity to you and yours. And remember, financial security comes to those who take a vested interest. Hey, thanks for stopping by. We'll see you in the next one. I'm not a financial advisor. Nothing in this presentation should be considered financial advice. I am only sharing my opinion and investing journey for educational and entertainment purposes. Investing involves risk. You can lose money and should never invest any amount you are not comfortable losing. Always do your own research. Invest based on your situation, circumstances, and select criteria, or seek the advice and counsel of a certified financial advisor.